Hey everyone, welcome back to Corporate Decoder, the place where we take these dense financial reports and try to find the funniest bits hidden inside. So today we are diving into Jingbo Technology Inc.'s latest filing. And let me tell you, this one has more twists and turns than a pretzel factory. Stick around because we are going to break down their financial performance, highlight some super interesting cash flow numbers, and even touch upon some really big changes happening with their business structure. Before we jump in, if you like getting the real scoop from corporate documents without all the jargon, make sure to hit that subscribe button. And hey, we have a growing community over on Discord where we share more insights. So join us there, link is in the description below. Alright, let's get started. This report covers the quarterly period that ended on the 30th of November 2025. The company is Jingbo Technology Incorporated and they are reporting as a smaller reporting company. Now, what does that mean for us? Well, it means they get to skip some of the more detailed reporting requirements, but we can still find the important stuff. So, let's look at where Jingbo Technology stands financially. On the balance sheet for the 30th of November 2025, we see their total assets are about $12.24 million. Now compare that to the 28th of February 2025 where it was $12.22 million. Not a huge jump, just a slight increase. But here is where it gets interesting. Their total liabilities are a whopping $37.9 million as of the 30th of November 2025. That is a pretty big number compared to their assets, and it is up from about $35.2 million at the end of February 2025. This means their debt has grown. For a company that is a smaller reporting company, this level of liabilities is something we need to keep a close eye on. Now, let's peek at how they are doing in terms of making and losing money. For the 3 months that ended in November 2025, they reported a net loss of about $815,000. That is a bit more than the $726,000 loss they had in the same period of 2024. Looking at the bigger picture for the 9 months that ended November 2025, their net loss was around $2 million. Now, this is actually a good sign because it is much better than the $6.2 million loss they had for the same 9 months in 2024. So while they are still losing money, they are losing it at a slower pace, which is a step in the right direction. When we look at the statement of stockholders' equity, it clearly shows the company has a deficit. This means that if you were to liquidate all their assets, they would still owe more than they have. As of the 30th of November 2025, this deficit is over $25 million. This is a pretty significant number and highlights the financial challenges the company has faced. Let's talk about cash, because that is what really keeps a business running. For the 9 months that ended in November 2025, Jingbo Technology used about $96,000 in cash for its operations. That might sound bad, but it is actually much better than the $1.2 million they used in the same period of 2024. So they are getting better at managing their cash flow from daily business. Their investing activities like buying or selling property used up about $105,000 in 2025. This is less than the $407,000 they used in 2024. So they are spending less on investments. Where they did see a positive cash flow was from financing activities. In 2025, they brought in about $257,000 from financing, mostly from loans from related parties. This is down from $1.6 million in 2024, but it still shows they are getting some outside money to keep things going. Overall, their cash position increased a bit, ending the period with about $175,000 in cash. Now, let's talk about how this company even got to where it is. Jingbo Technology Incorporated started way back in 2015 and initially focused on providing application software. But as you often see with these companies, they pivot hard. They've gone through a lot of ownership changes and business shifts. A key moment was in December 2022. When they entered into a share exchange agreement with Intelligence Parking Group Limited. This was a big deal because it led to Intelligence Parking becoming a wholly owned subsidiary. This transaction was treated as a recapitalization, meaning Intelligence was the one buying Jingbo in accounting terms. It seems like this move was instrumental in moving them away from being classified as a shell company. And here is a table showing their major subsidiaries and what they call Major V's. V stands for Variable Interest Entity, and it's a common structure for companies in China to bypass some foreign ownership rules. Basically, Jingbo Technology has contracts that give them control over these other companies and the right to their profits even if they do not officially own them all. This is a really common and important detail for companies operating in China. This section delves into those variable interest entities or VIs. These are critical for Jingbo Technology's operations, especially in the smart parking business. They have a whole web of these VIs and their subsidiaries, which are crucial for their business model. The company has all sorts of agreements like power of attorney, exclusive options. and business cooperation agreements to maintain control and get the economic benefits from these VIEs. These agreements allow Jingbo to act as the shareholder of these VIEs, giving them the power to make decisions, appoint directors, and generally control the companies. This is how they consolidate these businesses into their financial statements. These agreements give Jingbo the right to buy out the equity interest in the VIEs when and if allowed by Chinese law. The price would be set by law, and these options are valid for a long time. Now, this is a super important part. The VIE structure, while common, comes with risks. China's laws can be tricky, and there is always uncertainty about how they will interpret these contractual arrangements. If the government decides these agreements violate foreign investment rules, Jingbo could face serious problems, like losing control of these businesses. The company believes the risk is remote, but it is definitely something to be aware of. Looking at the financials for these VIEs, they show significant activity for Group 1, which includes Zhejiang Jingbo Ecological Technology and Hangzhou Jiyi. Assets are considerable, and they also carry significant liabilities. For example, their total liabilities for Group 1 as of the 30th of November 2025 are over $36 million. This highlights how heavily integrated these VIEs are into the company's overall financial picture. The company states their accounting policies haven't changed much. However, their financial statements themselves reveal a pretty significant concern, a going concern issue. They've had net losses for a while, ending November 2025 with a total deficit of over $37 million and a working capital deficit of over $7 million. This means they are burning through cash and might not have enough to cover their short-term obligations. Management admits there is substantial doubt about their ability to continue as a going concern. They are planning to raise money through equity financing and other sources, and they're getting some support from related parties too, but there is no guarantee they will succeed. This is a major red flag for any investor. Let's look at their physical assets. As of the 30th of November 2025, their property, plant, and equipment net is about $4.8 million. This has decreased from $5 million at the start of the year, so they're not investing heavily in new physical assets. The company has some significant loans. For instance, a subsidiary Hangzhou Jiyi has a loan with Zhejiang Chozhou Commercial Bank. In September 2025, they entered a new agreement for this loan. It has an interest rate of 4.5% and requires principal repayments starting in September 2026. The total loan amount is substantial, and it's secured by company property and a personal guarantee from Zhenjiang Luv. This section is always interesting. It lists parties that are connected to the company, like shareholders and management. We see they owe money to Guo Weijiang, the president, and have borrowed from other related parties as well. These transactions, like loans from related parties, are crucial for understanding the flow of money and potential conflicts of interest. For example, they owe over $2.4 million to related parties as of the 30th of November 2025. This is a really significant number. The long-term payables are over $22 million as of the 30th of November 2025. This huge amount is related to previous loan agreements with Jingbo, which were then transferred to various partnerships and ultimately to Shaoxing Kaqiao. This complex web of debt and transfers suggests a history of heavy borrowing and restructuring. Jingbo Technology breaks down its business into three main areas: parking fees, winery sales, and others. For the first 9 months of 2025, parking fees brought in over $1 million in revenue. Winery sales brought in about $70,000, and the others segment contributed around $101,000. Interestingly, the parking fee segment, while bringing in the most revenue, actually resulted in a significant net loss of over $2 million. Winery sales showed a small profit, and the others segment had a small profit too. This shows the dominant parking fee business is currently a drain on profits. Here they talk about risks. They mention credit risk with their bank deposits, but they are also heavily exposed to economic and political risks in China. This is a big one, as changes in Chinese policies can really impact their business. They also note interest rate risk, especially when loans need to be refinanced. We've already touched on this, but it's worth repeating. The company explicitly states there is substantial doubt about its ability to continue as a going concern. They face losses, have a large deficit, and a working capital deficit. Their survival hinges on their ability to secure more financing. This is the most critical takeaway from this report. Let's look at their operational performance. For the 3 months ending November 2025, parking fee revenue was about $300,000, down from $499,000 in 2024. This decrease is partly due to the termination of the Shaoshan Airport project, while their costs went down too, leading to an increase in gross income for that quarter. Overall operating expenses, particularly in selling and general administrative areas, have increased. For the longer period, the 9 months ending November 2025, parking fee revenue was over $1 million, down from $1.2 million in 2024. Winery sales revenue also dropped significantly, while overall costs decreased, leading to a gross profit where they previously had a gross loss. The increase in operating expenses still resulted in a net loss for the period. They are very upfront about their liquidity and capital resources. Their total assets are slightly up, but their liabilities have increased significantly. The cash flow from operations is negative, but improving. However, the financing activities, while providing some cash, are primarily from related parties, which is a double-edged sword. The going concern issue is reiterated here, emphasizing the need for new financing. Regarding market risk, they highlight that they are not materially affected by foreign currency exchange rates, but this is a bit of a bold statement given their operations in China. They do mention the potential for RMB fluctuations and acknowledge that hedging options are limited. In terms of controls and procedures, the report is quite candid. Management admits that their disclosure controls and procedures were not effective. They cite weaknesses like a lack of a functioning audit committee, inadequate segregation of duties, and insufficient written policies for accounting and financial reporting. They believe these are material weaknesses. This lack of strong internal controls is definitely something to consider. And finally, as for exhibits, they've included the standard certifications from their CEO and CFO, along with interactive data files, which is great for transparency. So, what is my take on Jingbo Technology Incorporated? This is a company that is clearly in a transitional phase, trying to navigate complex vice structures and significant financial challenges. The improved operational cash flow is a positive sign, but the ongoing net losses, substantial debt, and the very real going concern warning are major red flags. Their reliance on related party financing and the acknowledged weaknesses in internal controls add to the risk profile. The story here is one of survival and restructuring. They are making efforts to stabilize, but it is a long road ahead. For investors, this is a high-risk, potentially high-reward situation, but the immediate outlook is dominated by the need for significant new funding and a complete overhaul of their financial controls and reporting. Alright, that is our deep dive into Jingbo Technology Incorporated's latest report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more of these corporate breakdowns. And seriously, check out our Discord community linked in the description for more candid discussions. Thanks for watching, and we will see you next time on Corporate Decoder.